It's over in 10 days. Hey, everybody, you're watching Bull Boom Bear Bust. My name is JJ. Let's talk about what's about to happen here to the economy. And there's going to be a couple things that are going to be changing here in the very near future 10 days, maybe even 9 days, depending on when you're watching this video. But starting in October, we've got the resumption of student loan payments. And some of you may be saying, oh, we know about that. But let's talk about the impact of this here because there's a lot of things happening right now. We want to connect the dots today and also kind of paint a broader picture of where this economy is headed. You know, I don't just like to cover the news. I like to wrap it all up in a nice little package and kind of present to you what I think is going to be happening here, looking out 6, 12 months, maybe even a year and a half, right? So, wow, let's talk about this here. Student loan payments resuming. The data I have here is saying it's going to be between typically 250 and 450 a month for most people. But the big part of this is the number of people in student loan debt right now. And it's a lot of debt. And it's over 40 million people. 40 million people. And the amount of this debt is enormous. This is $1.8 trillion. That's trillion with a T, just under $1.8 trillion. Now, the bad part about this is the bulk of the population that has this debt are already in big trouble. Here's a statistic right here. 50% of young adults are living at home with their parents. 50% of young adults are living at home with their parents. It's amazing that there's such a housing shortage with so many people living at home. Isn't it amazing how these home prices just refuse to really come down and crash with mortgage rates? We're going to talk about that here in a few minutes. But the resumption of these payments is going to be pretty big. So with a consumer-driven economy where roughly 70% of the gross domestic product is consumer spending and people swiping their credit cards and going on shopping sprees, all the things people spend money on here in the United States, well, that's about to slow down very significantly. And when the economy depends on people spending, that could spell disaster. And I think we're going to start seeing things accelerate to the downside here in the fourth quarter, which is coming up here in October, also, which is the beginning of the fourth quarter of the year, which is typically when you see a lot of economic turmoil unfold. And if we look back at history, we see a lot of the market crashes have happened in the fourth quarter. Now, I'm not saying that's going to happen. There's a lot of forces behind these markets right now to keep them propped up. And I think all of you know what I'm talking about, especially with next year being an election year. So I don't think they want to have this thing implode. But if you also look back at previous rate hike cycles, the rates have been increased typically until something breaks. In 2007, 2008, it was the housing market. And of course, what did they do after that? They cut rates. They went back to QE. And, ever since we've had this bull market, this massive debt binge, giving the illusion of an economic boom. But it's been basically debt driven. We see the national debt's up to $33 trillion now. And it only took a little over 3 months, I believe, to do the last $1 trillion from 32 to 33 trillion, which is pretty alarming. That set a new record for the pace of how much debt we're taking on as a country. But yet we've got the Fed out there, the chairman out there saying how strong the consumer is, how strong and resilient the economy is. But if it's so strong, why do we have to rack up so much debt? It's simply amazing, right? So let's talk about the student loan debt. And what's going to happen when student loans start defaulting? Well, it can get as bad as these holders of these student loans, this debt, getting their wages garnished. And I've got a report here. This is out of Personal Finance, out of Marca here. And I'm just going to read a section here because it sums it up pretty well. Missing on your student loan payments will rack up both penalties and fees. This will inevitably make your debt far more expensive, of course, than it already was. Also, the most important part is that your credit score will take a massive hit. So there's going to be a bunch of more buyers that can't get a home loan unless they really do something crazy on the eligibility to get a home loan. If you plan on getting other loans, paying for cars or getting credit card or house, you'll want to keep up to date with your student loan payment. So, of course, this is going to impact people's credit scores. It's going to impact their ability to borrow. And back to what I said a few minutes ago, what does the U.S. economy need to avoid plummeting? Well, they need people spending money, borrowing money. So if you have tens of millions of people no longer qualifying for loans, a lot of these loans, then you're going to see major impact on the economy. And this is going to go all the way into people that own their homes today. You're going to see a lot more job losses because the less spending in the economy, the less people are needed at their jobs because companies are not making as much profit. And then you start seeing more layoffs, and then everything starts snowballing. So that's when you're going to really see the storm of current homeowners listing their homes on the market. And that's when you're going to see the inventory skyrocket. I always like to tie the housing market into economic news. I'm not sure why. That's kind of where this channel began. If you remember, if you've been here for a few years, you know, I kind of started off just focused on housing and kind of branched out into the broader economy, and have learned a lot along the way with your help. And thank you for being here. But back to this here, what the impacts could be could go all the way up to garnishing the wages. Not paying your student loans could get you a 6% late fee if it's 30 days late. If it's 90 days, you'll get reported to the credit bureaus as delinquent. After 270 days with no payment, your loans go into default. With private student loans, not paying this has different consequences than federal student loans. You'll get charged late fees, and your debt might get sold to a collection agency. You'll see damage on your credit score, of course. The lender can even take you to court. If the lender's lawsuit is successful, here it is, they may even get permission to garnish your wages. Now, I know some of you will probably be saying, oh, they're just going to forgive the debt and just include it in bankruptcy or change the law so people can file bankruptcy and get rid of their student loan debt. But think about the position we're in right now with inflation. With that many people discharging that much debt, almost $1.8 trillion, that would create, I think, a spending storm. When people get their debt eliminated, what do they want to do? They want to go out and start buying more stuff because they no longer have debt. So it's kind of the cycle begins again. But with prices where they are, the cost of living and asset prices, rents, homes, everything else where they're at now, I think the last thing they want to do is allow people an easy way out of this debt. And I don't think they're going to change the law to include student loans in bankruptcy, because that would really wreak havoc on the fight against inflation, right? And the fight against inflation is pretty much a losing fight. And we talked about that in our last report. But this is going to be pretty big, folks. I think October, a lot of eyes are going to be opening up saying, wow, what's going on here with the unemployment rate jumping up, the layoffs jumping up. And this student loan payments is just part of a broader picture here that we want to talk about, and just one of the pieces of the puzzle. But it's pretty massive here. And, we're going to watch this together. We're going to sit back, grab your popcorn, and, watch this economy take another turn down. We've already taken a turn down. It's just most people haven't realized it yet, because you have the talking heads out there, the business news reporters, of course, the chairman out there giving the speeches on how strong the economy is, how resilient the consumer is. The consumer is resilient, and the consumer is strong. If you consider borrowing money strength, then yes, the consumer is strong. But borrowing and going deeper in credit card debt is the way that consumers are having to survive right now. Another pin that's going to be popping or flying at the housing bubble, maybe not popping, but attempting to pierce the housing bubble. Another pin attempting to pierce the housing bubble is these mortgage rates, folks. Let's talk about what's happening here. We've got the 10-year Treasury yield spiking again, even since yesterday when I last reported on it here. And it's up to about 4.5 right now. And of course, it'll change by the time I publish it, because the markets will be open. But folks, this is huge. And this is directly correlated to mortgage rates, right? So they are connected. And if we look at the mortgage news daily number, it's approaching 7.5%. Even the Freddie Mac number right now, the mortgage rate for Freddie Mac 30-year fixed mortgage, under 7.25%. So these rates are spiking. The treasury yields are spiking. Why is this happening? Well, we have a lot of foreign buyers that are backing away from gobbling up U.S. debt like we've seen in the past. And this is all part of the, I think, a de-dollarization with the BRICS nations or BRICS plus nations going outside of the U.S. dollar. The buyers are not there for the U.S. debt like they used to be. The Fed's not there as the buyer of last resort like the Fed used to be. In fact, we've got the balance sheet now approaching 8 trillion. That's a huge number, I know, but it was close to 9 trillion for a while. Now we did see the balance sheet increase right about the time of the series of bank failures that we had at the beginning of this year. So I think, of course, everything's going to be flipped into reverse at some point when markets crash or when more banks fail or when just things get too bad in general. I think they're going to flip it and start cutting rates and re-uptake on the QE and start increasing that balance sheet. But right now it's down about $1 trillion from the high, and this assets of the Fed there down from 9 down to $8 trillion. So this is what we're seeing. This is why we're seeing spiking bond yields and therefore spiking mortgage rates. Right, the Fed's taking a hands-off approach now, not completely hands-off. If they took a completely hands-off approach, you would see yields and mortgage rates jump up to 10, 12, 15% in a matter of months. So they're being very careful and being very methodical and slowly reducing their balance sheet and slowly raising the Fed funds rate. As most of you know, they're being very careful. Even with them being very careful, look what's happening. So we've got predictions that mortgage rates could be hitting 8%. The economists warn of 8% mortgage rates after home sales disappoint. Wow, folks. So it's about ready to get interesting, and we've got to keep an eye on a lot of things here. Automobile prices, the housing market. Automobile prices, we've got an inflationary force happening right now with the strike. We haven't really seen a crash, in really any area of the economy yet, with the exception of some individual stocks that are pretty down pretty low. A lot of major stocks are down at 52-month lows right now, or 52-week lows. I'm sorry, 1 year 52-week lows, and stocks like Dollar Tree, Dollar General. And so individually, there's a lot of stocks out there that people are really getting crushed in. The broader indices are doing pretty well. You have a few mega companies out there that are kind of keeping these indices up. But I would be very cautious about how you're invested right now because things are about ready to take a turn for the worst. And I know I've said that before, but look, we've been right. Unaffordability got worse over the past year or two. Debt has gotten much worse. So there's really no easy way out of this. They can't cut rates right now because inflation is already so high. But what if markets come down? Let's say the stock market has a big drop, but yet inflation is still elevated. What's going to happen then? They're going to be forced to keep rates high because of inflation, or will they come in and rescue the markets even though inflation's too high and make inflation go even worse? Could we be headed into hyperinflation if they do that, right? So my point is there's a lot of risk out there right now, folks. And, you've got to be positioned for both cases. And it could be very complicated. It could be a combination of inflation, deflation, rising prices over here, falling prices over there. But you combine that with the job losses that we're going to see, it's going to get messy real quick out there. All right, now something else that's going to keep rates going up is this continued de-dollarization and countries going outside of the US dollar. One of the latest countries to jump on board of this alliance here, the anti-dollar alliance, is Indonesia here. It's being reported out of Business Insider. The de-dollarization drive is spreading wider. Indonesia is the latest nation to join the anti-buck movement, the buck talking about the dollar. The international campaign against the dollar's dominance of global trade and investment flows is pulling more countries in. Indonesia is the latest to join in on the movement, folks. So the world's waking up that we've been using and abusing the dollar to dominate, basically dominate the world with a military that's trotted all over the globe, Globetrotter military, not the basketball team, but the military, going all over the globe, and what's many have called the policemen of the world, and bases in hundreds of different countries, and just trillions of dollars spent on military budgets, you know, just bloated. And this is what empires do. And this is only made possible by having the world reserve currency that can be created in unlimited amounts out of thin air. So we knew that what we're seeing now was going to get here. We didn't know how long it was going to take, but the world's waking up, and we better be pretty careful about how we're positioned and going into this next economic downturn. I mean, the downturn's already here. It's just most people haven't realized it. And again, why? Why haven't they realized it? Because economic growth is being masqueraded um, based on debt, right? So they're using debt and using that to show how strong the economy is, but really it's just people taking on debt. But there's an end game to that too. There is a limit to that. It's not unlimited, unless again they do massive debt forgiveness. But then you'd have inflation really skyrocket and roar if you saw massive debt forgiveness. So no easy way out of this, folks. And even I don't know too many people that are as prepared as they really need to be for this. I know I'm not, and maybe you are, but I think a lot of you aren't, because a lot of people that I know and talk to directly, a lot of people aren't even really worried about this, right? They're thinking that things are getting better. They were sold this line for 3 years that there's an economic recovery ever since all the shutdowns and all the massive chaos that we saw in 2020, and they're thinking that things are going to get back to normal. Normal's gone, folks. Abnormal is the new normal. So I guess if you want to say normal's here, yeah, abnormal is the new normal, and it's going to continue to get crazier. All right, let's get into some other recent news here that's going to continue to paint the picture on what's happening right now in this economy here globally, but specifically here in the U.S. Olive Garden, the restaurant, the Olive Garden, warns, quote, decline in fine dining as wealthy Americans trade down to cheap booze. So I guess they have a pretty big drinking crowd in there that comes in there and gets drinks and dinner. But they are downgrading to maybe draft beers. I don't know. We're seeing a little softness versus last year with household income above 125,000. They're talking about the customer base that makes 125,000 plus, and that primarily affects our fine dining brands, but it does affect all of our brands. So Olive Garden's seeing a shift in the consumer. We know the consumer's already shifted in retail. They've already shifted away from higher end stores like Nordstrom's and Macy's down to Target and down to Walmart. Um, so the shift is continuing, and you just have to kind of look at the broader picture here to see what's going on. So I think we have less than a year, and typically I don't like to put timelines on things because so many things can be adjusted and manipulated, such as all the rescue packages and programs that we saw back in 2020. We've got 40 plus million people on some sort of food program, assistance program, and they could really ramp that up. But again, you have inflation in the background that you have to be really careful about how much you hand out to people, because as people spend the money that they're handed, demand goes up and therefore prices go up, right? So really dangerous time here, folks. I wouldn't want to be making the strings or pulling, I wouldn't want to be making the decisions or pulling the strings on this economy right now. Um, of course, they're going to find something or someone else to blame. That continues to be what I think about in the background. What's going to jump out and send a shock through the world? Another 2020, maybe 2020 2.0 coming at us here. But at any rate, let's keep stacking, folks. You want to have hard assets. I got a link down below to a place that has a lot of silver in stock right now. I've been scooping up bars and coins. Link down below, also in the pinned comment. And if you want to help out this channel, buy through that link. And it's a really good selection. The prices are really good. I continue to brace for the next monetary structure, and I think it's going to be metals backed. Now, we haven't really heard a hint out of that yet, but when you look at the countries that have scooped up the most gold in the past couple of years, Most of them are in the BRICS alliance, folks. So de-dollarization, these companies scooping up precious metals, and I think ultimately that's going to be the tool that's going to be used for trade, and that's going to be the basis of the monetary system after we see a lot of pain spread throughout the world, including here in the U.S. We're not going to be immune to this. So keep stacking, folks, and get ready for what's coming. You also want to have cash. I don't say put everything in one basket. Be ready for anything. Crashing prices, deflation, but also be ready for the shift in the monetary system or inflation, because metals can also help you protect your wealth against inflation. And that's it, folks, for today. So we're going to wrap this one up. As always, big love, everybody. Keep stacking. Bye for now. Peace.